Hello everyone, we are now starting with the new topic from our valuations and risk models book, that is measuring and monitoring volatility. So till now what we have done and what is this, let us understand the whole theme in which we are at present. First of all, we have seen the measures of financial risk means we want to quantify the risk. This is the first topic. In the second topic, we have studied in a detailed way war and expected shortfall, because we have seen here the different methods of calculating or measuring the risk. One is our that mean variance framework, where we are using the standard deviation. Then I told you that our focus is on the left tail, so we have introduced war and expected shortfall. But in this topic there was just a touch upon on the war and expected shortfall. In the second topic we have a very detailed discussion on the calculation of war and expected shortfall. Clear? Apart from this, we have seen different methods in which we can calculate war and expected shortfall. Now if you'll remember the formula for calculating the war, it is mu minus z into sd. Clear? Now this chapter is completely focusing on this standard deviation, or you can say volatility. Means if you can't estimate the volatility, you cannot estimate the war. Can you say that war is dependent upon the volatility? Can you say that war is dependent upon the volatility? If you will be able to give the correct input, definitely you are going to get the correct output. If you are giving the garbage, definitely you are getting the garbage. Clear? So this chapter is focusing more and more on the volatility, because this is something which is very difficult to estimate. Volatility is something which is very difficult to estimate, because it is not standing in front of your eyes, and it is something which is changing on the regular interval of time. This is something which is changing on the continuous basis. Hopefully you are understanding the theme of the topic, that in this topic my focus will be completely on the estimation of the volatility. Clear? Okay, so let us map out the things which we are going to study in this lecture. Clear? Okay, so these are the 4 topics which we have to cover under this chapter, in which first one is the returns are not normally distributed. Now here author is trying to say that returns are following normal distribution, but in reality we want to prove, okay, that returns are not following the normal distribution. Clear? Second is we are again revisiting the war. So you can see that from the first topic itself war is very important. But here we are revisiting the war. Okay, so the concept is going to be very easy and fast. Here it is going to be very easy and fast. Again, when we are estimating the volatility, this portion is very important and something new we are going to look at this part. And mean reversion and long time horizon is, again we are going to discuss some of the characteristics of the volatility. Okay, when I am saying the mean reversion, what is the meaning of mean reversion? That this is the mean. Okay, this is the mean of the volatility. Clear? Now if the mean is somewhere here, so over the period of time it will approach the mean. Okay, it will start decreasing. If the volatility is here, it will start increasing to reach the mean. So this is known as mean reversion characteristics of the volatility. Clear? These 4 things, if we will be able to cover in a very smooth way, the chapter is going to be very easy for us. Okay, so in the first part, that returns are not normally distributed, here the author is trying to prove that my returns follow normal distribution, but I'll be giving you that why my returns are not following the normal distribution, what makes them to move away from the normal distribution. And this will require the basic knowledge which we have covered in our quants about the skewness and kurtosis. Skewness and kurtosis will be helpful when you will be studying here. Now if you remember that when skewness is not equals to 0, we can say that my distribution is not normal. When my excess kurtosis is not equals to 3, when my excess kurtosis is not equals to 0, my excess kurtosis is not equals to 0, this means that my returns are not following normal distribution. Clear? When skewness is equals to 0, my data follows normal distribution. When excess kurtosis is equals to 0, my data follows normal distribution. Clear? So in reality, if I'll talk about the reality is that my distribution is skewed. The distribution of the returns, the data of the returns are actually skewed. Clear? So means there is a skewness. Returns not follows normal distribution, and my data having fat tail. So because of being the fat tail, I can say that my data do not follow normal distribution. Clear? So we are going to discuss this returns are not normally distributed in a very detailed way. But just for the summary of this chart, let us write down the 3 reasons that we can conclude that the returns do not follows normal distribution. First is, write down fat tail. Fat tails means there is a kurtosis, and then my data is skewed. And then unstable parameters. Write down unstable parameters. And what are the parameters of the normal distribution? Parameters of the normal distribution is mu and sigma. Clear? Normal distribution assumes that the mu and sigma is same, but here we will conclude that the mean and sigma are actually not constant, they are changing over the period of time, or we can say changing with the data. So let us start this heading. So my returns are not following the normal distribution. The reason is fat tails, the data is skewed, and the parameters are actually not stable. Let us begin with our fat tail. Okay, how my normal distribution looks like. Okay, this is my simple normal distribution where the tails are very thin, close to x-axis, but when it comes to our fat tails, you can see that here the probability is higher in the tails, and higher around the mean. Probability is higher in the tails and higher around the mean. You can see here that it's higher in the tails probability and higher in the middle. Means when it comes to the data, it is very close to the mean, most of the data, and some of the data are deep inside the tail, and even for those data the probability is higher. Clear? Now most important thing is that the mean and sigma of both the red diagram as well as the black diagram is same. The mean and sigma for both the diagram is actually same. This is my actual data. And the red one sorry, the black one is actually the normal distribution. So this is a comparison between the normal distribution and the actual distribution. So one point which I can compare is that the mean and the sigma of both are same. Clear? But the point of difference is in the tails. Our normal distribution, assuming that there is a very low probability for the tail event, but the real data is showing us that there is a huge amount of chances that my returns can go deep inside the tail, and it have huge amount of probability when it is compared with the normal distribution. Clear? So this is one reason where I can say that my data do not follows normal distribution. Clear? And you can say that what kind of kurtosis this is? This is leptokurtic. Okay, so I am not going to discuss these things again because I have covered in a very detailed way. So this belongs to leptokurtic, and where excess kurtosis is greater than 0. Clear? Now let us come to our second point, which is about the skewness, that my data have some skewness in it. So we are assuming that data follows normal distribution, but in reality it is negatively skewed. In reality it is negatively skewed. Clear? Now when I am saying negatively skewed means what? There is the chances of negative losses. There are chances of high losses. You can write down chances of high losses. Clear? So if I'll draw the curve, suppose this is my normal distribution, actually not looking like normal. Okay, this is my normal distribution. Now I am drawing the negative skewness. Okay, negative skewness is somewhat like this. Means there are higher chances that you can have the huge amount of losses. Means there are huge probability into the tails. Clear? So this is the reason. Another reason I got to say that yes, my data do not follows normal distribution. Author is saying data follows normal distribution, but we are able to prove first that my data have excess kurtosis greater than 0. My data have negative skewness. Clear? I have given 2 reasons till now to ensure that data is not following normal distribution. Clear? Now let us come to the third reason, which is about the instability. Means the parameters, that is the mean, the sigma, they are actually unstable. Now try to first of all understand the logic. If I am taking the data for the period of 1 year starting from January to December. Okay, now can you assume that the volatility for each month is going to remain the same? Because here I am drawing the graph of normal distribution, and this graph is saying that my sigma is 3.2%. So is it possible that your volatility is constant to 3.2? No, it is actually changing from time to time, and there can be many reasons for the change in the volatility. It can be the inflation, it can be the equity returns, it can be any interest rate, can be any pandemic, okay, can be any market crisis, anything which can really spike the volatility, and it can really decrease the volatility. So means what? In reality my data is not actually, the parameters of the normal distribution is not actually constant, they are actually changing. So if you are assuming that your volatility is constant, how you calculate VAR? I calculate VAR as mu minus z into sigma. Now if you are using constant mu and constant sigma, you are doing wrong with the VAR, because in reality your volatility cannot be constant, your volatility is actually changing. So we should not use normal distribution because it is assuming that you have a constant mean and a constant standard deviation. Clear? Okay, so we have concluded that my data do not follow normal distribution because of its unstable mean and unstable sigma. So here author again started debating, okay, with us he started debating that okay, I will give you a better way. If you are saying that it is changing over the period of time, let us transform this normal distribution. Let us transform this normal distribution. If you are taking the data for 1 year, divide the data in 4 equal parts of 3 months. Divide the data in 4 equal parts of every quarter, and for every quarter you will be getting the normal distribution. For every quarter, if you are arranging the data, definitely you are going to get the normal distribution. Now they all 4 are normal distribution. They all 4 are normal distribution. Clear? Everyone will be having mu1, mu2, mu3 and mu4. Everyone will be having different sigma. So means he is trying to say that okay, if you are using the single normal distribution for the 1 year, and if you are not satisfied, okay, divide the period into 4 parts and then you should calculate. Okay, but again this theory is going to be proved wrong. Okay, let us start and make this theory to prove wrong. First of all, this distribution is actually unconditional distribution. Which one is unconditional? This one is unconditional distribution, because there is no condition. Clear? But the second one is actually my conditional distribution. Here I am putting the condition on data, conditional distribution. Clear? Now let us understand and let us make us this portion prove to be wrong. So let me complete the thing. This portion I am mapping with this graph, clear, and this conditional distribution I will be discussing from this side. Okay, conditional distribution. First of all, I want to say that your mu1, mu2, mu3 and mu4 are actually equal. Your mu1, mu2, mu3 and mu4 are actually going to be equal and equals to 0. Clear? So try to think first way that if your mu are actually equal, what is the use of dividing the whole period into 4 equal parts? When your mean is going to be equal, it is not beneficial enough for you to find out to divide the period into 4 equal parts. Now the question is that why my mean is actually equals to 0? Why my mean is actually equals to 0? The reason is that when you have the whole data, and you want to find out daily mean, okay, it is going to be close to 0. Suppose I will give you the example. The mean of the data is say 2%. The mean of the data is 2% for 3 months period. Now you want to find out the mean, or you can say you want to find out daily mean. So how you will find out the daily mean for the 3-month period? So you need to divide it. By 60. So the value is going to be 0.03. So you can see the value is close to 0. Or when you will increase the period, suppose your mu is 3% for 6 months. Clear? Where your mu is 3% for 6 months. So what will be your daily mean? What will be my daily mean? My daily mean is 3 divided by 120. So it is coming to be 0.025. So you can see that the mean is actually approaching the 0. Clear? So there is no use of actually finding out the 4 different mean, because the mean is going to be equals to 0. The mean is going to be equal. So I have proved that the mean are same. No use of converting the unconditional distribution to a conditional distribution. Okay, sir, till now you have only proved mean is equals to 0 or mean are same. What about the volatility? What about that you will be having different sigma, that is sigma 1, sigma 2, sigma 3 and sigma 4. What about them? Okay, we'll come upon them, but there is one more important point. When you are talking about the return, okay, the return which you are willing to get, okay, the return which you are going to get in reality is actually a random number, and when I'll say when my returns are following the random number, what is the reality? The random numbers you cannot predict. You cannot predict the random numbers because they follows random walk. So in reality you cannot predict the expected return, that is mu. You cannot predict the expected return, that is mu. Why? Because the returns are random number. You cannot predict the random numbers. Returns are random number. You cannot predict the random numbers. Why? Because they follow random walk. And if they follow random walk, then the expected value of all the returns is going to be 0. Expected value of all the return is going to be 0. Clear? So based on this idea, now let us understand this portion. What I am saying, that I have the data for the whole 1 year. And now I am finding the volatility, that is sigma 1, sigma 2, sigma 3 and sigma 4. So what I want to do, I want to neutralize my return from the impact of volatility. I want to neutralize my return from the impact of volatility. Clear? So what I will be going to do, what I'll be going to do, simply I'll find out z value. Simply I'll find out z value, that is my actual return, whatever actual return I'll be having, minus the mu divided by sigma. So what I am trying to do, I am neutralizing the impact of sigma. Means I said to the author that okay, if you believe that my data is actually normally distributed, but it is not coming normal because of the standard deviation, okay, let us remove the normal distribution, let us remove the volatility from the data, and now let us check whether my data follows normal distribution. Again I am saying, my data, this is my data, and I proved that not following normal distribution because of volatility, because volatility is actually changing, so I can say my data do not follow normal distribution. So now what I did, I said okay, remove volatility from returns, whatever returns you have, remove the volatility from that. Clear? So what is the way to remove the volatility? To find out the z value, that is x minus mu by sigma. Now mu is actually 0. So how I'll simply find out the z? It is x by sigma. Okay, so after putting all the values of x and sigma, means for all values of x, I'll be able to calculate all the values of z. My x is not following normal distribution because of the volatility. Now this z do not contain the impact of volatility. It do not contain the impact of volatility. Now author was happy and he tried to check whether z follows normal distribution or not. Now he came to know that it is also not following normal distribution, means my data is not actually following the normal distribution in reality. That whether you use conditional distribution or unconditional, the fact is that returns do not follow normal distribution, and simply you cannot guess the volatility. This is the thing which I want to convey you from the beginning, that to find out the volatility is very simple, is very easy. You cannot simply use the normal distribution and predict the volatility. It is going to be very easy. Clear? It is not a cup of tea like okay, assume data follows normal distribution, find out the standard deviation. No, it is not the fact. My data do not follow normal distribution, so now it is very difficult to find out the volatility. This is the theme which I want to put in front of you. Clear? If data would have followed normal distribution, then simply we can use the normal distribution to find out the volatility, and there is no use of all the methods of estimating the volatility. Why we are estimating the volatility? Because my data is not following normal distribution and I cannot easily predict the real volatility. That's why I have to study this topic. Clear? So this is the whole point about the returns are not normally distributed. Now under this section only there is one more small topic, which is the regime switching. So means you are switching from a regime, okay, or you can say you are switching from an era. Okay, if I'll talk about that, there was an era of Ronaldo. Okay, there was a era of Ronaldo. Now there is an era of Messi. Okay, in future there is an era of Neymar. Clear? When I'll talk about the cricket, there was an era when Kapil Dev used to play, Sunny Gavaskar used to play. Then we got the era where Sachin Tendulkar used to play. Then we got the new era in which Virat Kohli is also playing. So there is an era and different way we are doing our cricket, we are playing our cricket. Means if I'll talk about the era in which Kapil Dev used to play cricket, 200 was considered to be a very good score. When Sachin came to play, it was considered 300 is a good score. When Virat Kohli's era started, 400 was considered to be as the good score. So means we are changing the era, we are changing the period, we are changing the period. Clear? But this regime switching we will discuss from the point of view of the volatility. From the point of view of the volatility, what happen is that if your volatility is increasing, okay, then it will increase very fastly. Clear? It will be a very high volatile period. When the volatility is decreasing, okay, you are going to experience a very low volatile period. But if suppose you are into a very highly volatile period, it will take even a very short period of time to decrease the volatility. If you are at a very low volatile period, it will take a very small amount of time to change the regime from the low volatility period to the high volatility period. It can change very quickly, it can change very quickly. So means you are changing your regime from high volatile to a low volatile in a short period of time, from low volatile to the high volatile in a short period of time. We are saying that regime switching. Clear? So this usually happen when we get some information, new information which can really impact the market. Suppose the market is trading like this currently. Okay, this is 2 p.m. now, and we got new information from the government that they are increasing the tax on the capital gain. So what will happen? You will see that market will fall down, means you will see the huge amount of volatility into the market, because you got some important news and that needs to be incorporated into the market. So this is known as regime switching. We are switching from the moment of high volatility to the low volatility, or from the low volatility to the high volatility period. Clear? So this is the end of our first topic, that is returns are not normally distributed. Now we will start with our second portion, which is about the war. Previously we have calculated the war with the three methods, okay, but in this topic the war is described in little different way. That is, one is the parametric method. Write down parametric method, and other one is non-parametric method. Okay, I'm removing it here. Non-parametric. Okay, now when I'm saying parametric method, I mean that this belongs to the delta normal method. When I'm saying parametric method, means I'm calculating VAR and I'm assuming certain distribution for the return. Parametric means you are assuming certain distribution for your return. Non-parametric means you are not assuming any distribution for the calculation of your VAR. Clear? So this is similar to my delta normal method, and this one is similar to my historical simulation method. Clear? Just a new name. Delta normal method also known as parametric method. Historical simulation method also known as non-parametric method. So here we need to simplify the things rather than stretching the things more and more. Now one more important point, that in both, that is parametric method and non-parametric method, we are using the historical data. Okay, so don't get yourself confused with the fact that this both belongs to historical and I am specifically saying this to the historical. I am using historical data in both the method, but this historical simulation method is totally different. So for the parametric method, we are assuming that my data follows certain distribution. It can be normal or it can be log normal. Second, when I am saying normal or log normal, I am assuming that it is taking the time varying volatility, the volatility which is changing with the time. Clear? This is our parametric method and non-parametric method. Another thing I have discussed, that my returns are actually normally distributed. normally distributed, and they follows random walk, they follows random walk, and if they follows random walk, my mean is going to be 0, because the expected value of all the data which follows the random walk is actually 0. Clear? This is the whole concept of our delta normal method. Clear? Now one more important point with respect to VAR which I want to discuss with you. Suppose here we have 100 data, okay, and I want to find out 5% VAR. Then definitely till now what I have told you is to take the fifth value, clear? But there is another point which is saying that better to take the average of fifth value and sixth value, better to take the average of fifth value and sixth value. So means there are two possible answer for the calculation of VAR. One is either the fifth value, or the second option is the average of fifth value and sixth value, the average of fifth value and sixth value. Clear? Now till now we have seen that in the examination they give only one value which is related to the fifth value. But what if you will find out both the values, that is fifth value and fifth and sixth values average? Means if in the option you will find out both the values, the average of fifth and sixth and the fifth, then you have to choose fifth, because till now we have seen only the values which are related to the fifth value in the examination options. Clear? Now non-parametric method. So in the non-parametric method there are actually two methods. One is the historical simulation method and another method is MDE, that is multivariate density estimation, Now I have discussed this previously, so here I am not going to discuss it again, but just the basic idea. If here I am creating the VAR and I am choosing the VAR at this level, if I am choosing the VAR at this level, means what? I am giving 100% weight to this value, I am giving 100% weight to this value. But what about the MDE? What about MDE? It first analyze the data. Suppose this is the whole data of the past 100 days. If this is the data of the past 100 days, and today you need to calculate the VAR. Now it will analyze the situation of today. It will analyze the what is the situation today, and we got to know the same situation is available here. The same situation is available in the break in this area only. This area is actually belongs to the situation which is present today. So this method is actually going to give higher weights to this scenario. This method is actually going to give higher weights to this scenario. And in what sense they are actually the same? They are same with respect to the volatility. Means here the volatility is close to 3.2%, and today also the volatility is close to 3.2%. So I'll be giving more weights to this area, and based on this I'll be calculating the VAR. Clear? So this is giving 100% weight to a single data, but multivariate density estimation is actually understanding the situation today and over the 100 period, which period actually having the same situation, and then I'm using that data to find out the VAR today. Clear? Though we are using the historical data, but the approach is different. We are using the historical data in both parametric approach as well as non-parametric approach, but the difference is that how we are actually using the data. So historical data we are using, non-parametric method, parametric method. In the parametric method we are assuming the normal distribution, but the parameters from the normal distribution coming from the historical data, and then I am calculating VAR. When it comes to non-parametric method, we have two methods, historical simulation and MDE. In historical simulation, 100% weight to a single point. When I am doing the MD, I am choosing the data which resembles the situation of today's, which resembles the situation today. Clear? This is the whole point about the war calculation, parametric method, non-parametric method, and historical data. Now we will study the advantages and disadvantages of parametric and non-parametric methods. So first advantage, okay, if I'll say for non-parametric method is that no no assumption, no assumption, no assumption about distribution. Okay, because non-parametric method do not need any kind of distribution. So now if you are not assuming any distribution, then there is no case of fat tails, no case of fat tails, no case of data skewness, clear, and no case of unstable parameters, clear. These are the advantages. Apart from that, MDE give more weights to the relevant data. Okay, the focus is on the relevancy rather than the recency. Okay, means if you look at the some of the model, they gave more weight to the recent data and lesser weight to outdated data. But MD is an approach which give higher weight to the data which is relevant. Okay, recency is not important, relevancy is important. Now one more important point which is related to MDE, that it can choose its variables. Okay, the variable on which my calculation is dependent. So it is very flexible when it is when it comes to the choice of the variables. Okay, it can, we say it as state variable, state variable, clear. Means what kind of variable, what kind of state are you looking for? Are you looking for volatility? Okay, are you looking for some good GDP growth? Are you looking for recession? What kind of state are you looking for? Suppose this is your data, this is your full 100-day data, clear. This is your current state. Now current state can be highly volatile, so you will choose which period is very highly volatile. Suppose you say that this is highly volatile, or might be you are choosing some different variables such as uh, state of economy, state of economy. So currently you are into recession, currently you are into recession, so you will find out which period belongs to the recession. So you got to know that this period actually belongs to recession, clear. So you will choose this data to actually find out the risk. So these four are actually the advantage of the non-parametric methods. Now let us see the advantages of parametric method. Okay, so first of all, when I say that I'm using the parametric method, means that I'm using the whole data. I'm using the whole data. But when it comes to non-parametric method, what I am doing? I am choosing some particular data, and from that particular data, I am finding out my risk. But when it comes to the parametric method, I am using the whole data. Clear? So I am using the data more efficiently. Clear? Now second disadvantage. Okay, so if I'm saying disadvantage for the non-parametric, consider it as the one of the advantage. When I'm using the MDE, suppose I want the period of high volatility, suppose I want the period of high volatility, and in this period of 100 days I do not have any such period. So means the data is not at all of use for me, the data is not at all of use for me. So means what? I need large amount of data which is related to my state. Here I need large amount of data which is related to my state. So you can write like this: disadvantage of non-parametric. Disadvantage of non-parametric, that MDE needs huge amount of data. Huge amount of data. Suppose one of my state is that I need financial crisis. So over the period of 20 years, you will find out that there is only one period, that is 2007 and 8, which is of financial crisis. So means I am taking the data of the past 20 years, and then I am getting one single period. Means not even many crises, I am having only one single crisis. So which is very difficult for me to analyze the amount of risk. Clear? Now apart from that, if you are using the concept of regime, okay, in the historical simulation approach, so means what, you are having, you have huge amount of data, but you are using only the portion of it, you are using only the portion of it, means inefficient use of the data. So this is including all the advantages as well as the disadvantages of parametric and non-parametric method. So we have efficiently covered two portion of this chapter, that is returns are not normally distributed and the revisiting the concept of war. Now we are just left with two portion which are dedicatedly towards the volatility. Okay, so let us continue with our estimating volatility portion. So we need to estimate the volatility, and it is for sure that we cannot accurately find out the right value for the volatility. That's why we are using the word estimation. So always keep focus on each and every word, means like why are you using the word estimation, because you cannot accurately tell what is the value of the volatility, that means how much volatility it is going to be. You can just estimate the amount of volatility. Your estimation must be close to what is in reality, then your model is great, otherwise your model is useless. Now in order to identify the volatility, we have actually three different models. One is the implied volatility, EWMA and Garch model. So I'll continue further with the detailed explanation of each of the three topics. Okay, so let us start with the first one, that is our implied volatility. Now, one of the important thing with respect to implied volatility is that this one is forward looking. This one is forward looking, and rest of the two, they are dependent upon the historical data. They are dependent upon the historical data. This one is also dependent upon the historical data. Clear? Now apart from this, it will give high weight to recent data, high weight to recent data. Clear? And Garch will also give high weight to recent data, and it will also include the concept of mean reverting. It will also include the concept of mean reverting. Clear? Now how we are actually working with the implied volatility, there are options which are trading into the market. Along with that, there is a VIX index which is also trading into the market. Now your option is trading live into the market, and if you can find out the value from that particular option from the market, that will be more accurate, because it is telling you something about the present which is really going on, as well as something about the future. So my option price is actually equals to the function of stock price, exercise price, time, volatility, as well as the interest rate. Clear? Now I know the option price because it is trading into the market. I know the strike price. I know the exercise price. I know the maturity of the option, as well as I know the risk free rate. Something which is unknown is volatility. So means if I have a equation, and in that particular equation five variables are there, and out of five variables I know four, so I can easily find out the fifth variable. Clear? Now this portion we'll be discussing in a very detailed way when we'll be doing Black-Scholes Martin model. So here I'm not taking it in a very detailed way, because a complete reading assigned for this particular topic. Clear? So you can also mention that Black-Scholes Martin model. Okay, so whenever we'll be doing that particular topic, we will be doing this whole thing. Okay, implied volatility thing. Clear? Again, just a small concept. If I am saying that your annual volatility, if I am saying that your annual volatility is 18%, if I am saying that your annual volatility is 18%, what is your daily volatility? What is your daily volatility. It is actually 18% divide by square root of 252. 18% divided by square root of 252%. Clear? Now from this particular chapter, if you are doing this implied volatility, the thing which I have explained you here is more than enough, at least for this chapter. Clear? Now what is two important points we have to cover is EWMA and Garch model. Now the aim of both the model is to find out the volatility. Okay, the aim of both the model is to find out volatility. What is volatility? It is actually the standard deviation. What is volatility? It is actually the standard deviation. Now suppose I'll be taking daily returns. I'll be taking daily returns means every day the stock of Amazon is giving me how much daily returns. Okay, suppose on the like 1st of January it gave me the return of 4%. 2nd of January it gave me the return of 3.5%. 3rd of January it gave me the return of say minus 1.7%. Clear? And so on you are getting the returns, and so on you are getting the returns. Clear? Now you got the return. How you got the return? You got the return from the price. You got the return from the price. So I'm not taking the price, I'm directly taking the return. Clear? So if I want to know how to get the return, simply what I will be doing, I'll be taking the difference between the yesterday price and today's price. Yesterday price yesterday what was there, minus today's price and yesterday price divided by yesterday price. This will give me the return, so this is how I calculate the returns, and my returns are continuously compounded returns. Clear? Now if I have the details of the return, simply I can calculate the mean, and simply I can calculate the standard deviation, our basic descriptive statistics. If we will be having our returns, we can easily find out the mean, we can easily find out the standard deviation of the returns. So suppose your mean is coming to 0.004%. Clear? And your standard deviation is coming close to 3%. So you can see that mean is close to 0 because first of all my data follows independent and identical distribution, or if the data is of huge amount and you want to calculate the mean of one day, definitely it is going to be very low. Clear? So the standard deviation is always, you can see it will always be greater than the daily mean. Clear? Now how we actually calculate the standard deviation? If you remember the formula, it is x minus mu x minus x bar whole square summation of x minus x bar whole square divided by n minus 1. Hopefully you are understanding the theme. Now when I got to know that my x bar, that is mean, is close to 0, and I have the huge amount of data. So when I have huge amount of data, whether to use n minus 1 or n, it is equal. So my calculation of standard deviation, or rather say variance, is equals to summation of x square by n, or in this regard you can say the summation of r square divided by n, means the square of the return divided by n will become your variance, or if you want to know the standard deviation, it will actually summation of r square by n. Clear? Means here you have, again let us see the example. Here you have the date, here you have the return. Now obviously we cannot find out the variance and the standard deviation from the return, we have to take return square. Clear? Usually what we used to take, we used to take return minus mean square, but my mean is actually 0. That's why what I am taking, return square. That's why I am taking return square. At the end I am taking the summation of return square. Now to find out the variance, what I have to do, I have to divide it by n, because when your sample size is very huge, so dividing a number by 252 or 251 will hardly make any difference. So simply we can use the n, the number of observation we have. Clear? So we can see that, what is my mean, my mean is actually summation of r by n, what is my variance, summation of r square by n. What is my variance? Summation of r square by n. So I have given you the explanation that why it is r square by n. Hopefully you are satisfied. Now you want to find out the volatility. Clear? So this is the one way to find out the volatility. But if I'm doing this, if I'm taking the average, finding out the variance and square root, I'll be getting the standard deviation. Means what? I'm giving equal weights to all the return square. So what I have to do? I have to give weights. Let us assume my alpha is the weight. Where sum of the weights has to be 1. Suppose this is the most recent return, because this return is of 1st of January, this return is of 2nd of Jan, 3rd of Jan, 4th of Jan, 5th of Jan. Clear? So suppose today is 25th of December. Clear? So this is the end of today's day, and I am getting the return for today's. So this is something which is the most recent, and suppose I will give the weight as 0.2. And then the previous day, suppose I am giving the weight like this. Means I am giving higher weights to the data which is most recent, and I'll be giving the lowest weight to the data which is older. Clear? So now what I'm trying to do, now I will find out r square alpha. Means I will multiply both of them. And here I'll be getting r square alpha. Now I'll be taking the sum of this. And when you are multiplying any number with the weights, you don't have to divide it by anything, because it's already averaged. Let me give you an example for this. Suppose here are four number, 4, 5, 6, 7. Clear? Now if you take the average, of this number, okay, let me make this number as 5 only. So this is actually the sum 20, and mean is going to be 5. Now when you are calculating the mean, what does that mean? You are giving the equal weights of 0.25. Clear? So here is your return, here is your weight. When you will multiply return and weight, what you will get? This is what you are getting. And now if you will take the sum, it is going to be 5. Now if you are going to take the sum, it is going to be 5. So they both are same. Means if you are multiplying with the weights, it is not important to divide it by any value, because it's actually you are getting the expected value, that is the mean. Clear? So here you are getting return square alpha, and alpha is the weight you are giving. Which you are giving. Clear? Hopefully you are understanding the concept. Hopefully you are moving step by step. First we calculated mean, we calculated standard deviation, we modified our standard deviation, and then we have given the weights, because we want to find out the standard deviation, where I'll be giving more weights to the more recent data and low weight to the past data. Clear? This is the scenario when we are calculating the volatility. Now this is your weight. What is your weight? weight is 0.2. Now next weight is actually 0.19. Next weight is actually 0.19. So suppose this is your weight 1. Now your weight 2 is dependent upon your weight 1. Weight 2 is dependent upon your weight 1, and I am multiplying it with some lambda. I am multiplying it with some lambda. Clear? Now try to understand what is my weight 2? 0.19. What is my weight? 0.19. Clear? So how I am actually able to find out 0.19? Because it is 0.2. So we can simply find out the value of the lambda. We can simply find out the value of the lambda, that is 0.95. Clear? So weight 2 is equals to 0.95 multiplied with 0.20, which is equals to 0.19. What is lambda? The lambda is the rate at which your weights will decay. Again, try to understand. What is lambda? Lambda is the rate at which your weights will decay. You can see that your weight is decreasing. Now you need to find out the rate at which you are going to decrease the weight. So that rate is actually lambda. Clear? So now let us remove this point 18 and let us find out the third weight. So the third weight is actually equals to lambda square weight 1. So it is going to be 0.95 whole square multiplied with what is your weight? 120. Clear? So let us find out. You will see that it is coming as 0.18. Clear? So here I will be mentioning 0.18. So means this portion is actually to make you understand that how I am actually calculating the weights. This portion is actually to make you understand that how I am actually calculating the weight. Let us revise from the first part. Day. Okay, or you can say date. 1st of January 21, 2nd of January 21, 3rd of January 21, like this. Say 31st of December 21. Now you have the closing price. You have the closing price of the Amazon. Now you need to find out the return. So first one will be the blank. Second one will be, say this one is P0, P1, P2, P3. So P1 minus P0 divided by P0, you will be getting the return. Clear? Similarly, P2 minus P1 by P1, you are going to get the return. Clear? Now from the return you can calculate the mean. Now to find out the standard deviation, what you are doing? You are doing return square. So you are getting the squared value. Now you are taking return square. I have told you why I am not deducting the mu, because mu is close to 0. Clear? So what is my variance? My variance is actually summation of r square by n. Now I improvised it. Rather than giving equal weights, let us give some weight, that is alpha. Clear? So here my weight 1, here I have weight 2, weight 3, weight 4, weight 5, weight 6. Clear? Suppose my weight 1 is 0.2. What is my weight 2? My weight 2 is going to be lambda 0.20. Suppose lambda is 0.95. So that will be multiplied by 20. Clear? So you will be having 0.19. What is your third weight? 0.18. How I am calculating? Lambda square 0.2. Then lambda cube 0.2. Lambda cube, that is 0.95 multiply with 0.20. You are getting 0.17. So this is how your values will decay, your weights will decay, and then you can find out return square alpha. you can find out return square alpha, and here you will get the summation. So that summation, that sigma square, new sigma square, that is summation of r square alpha, summation of r square alpha. So this one is better because I am giving the weights, higher weights to the recent data. This one is giving equal weights, this one is giving equal weights, and this one is giving higher weights to, this one is giving higher weights to recent data, higher weights to recent data. Now this is what I have explained to you just now, is nothing but my EWMA model. This is nothing but EWMA model. What is the meaning of EWMA? Exponentially weighted moving average, exponentially weighted moving average. And this lambda is actually exponentially decaying the weights. This lambda is actually exponentially decaying the weights, and this will become your EWMA model. Clear? So now if I'll write like this, that my variance is equals to weight 0 multiply with r square plus weight 0 lambda, weight 0 lambda multiply with r square. Next, weight 0 lambda square multiply with r square. Clear? So this one is actually on the 31st December, this one is on 30th December, this one is on 29th December. Clear? And this will go on, this will go on. Now this return is for n minus 1, this return is for n minus 2, this return is for n minus 3. Clear? You can see that this is one day before, this is one day before, because right now I am standing on 1st of January, 1st of January I am standing. Clear? So this one is n minus 1, one day before 1st of January, that is 31st of December. This is n minus 2, this is n minus 3. The return, I am just giving the notation to the returns. So this is how I calculate the EWMA model. This is how I calculate the volatility with the help of EWMA method. Clear? Now suppose if there are only two returns available, if there are only two returns available, then what we will be doing in that case? Now if we have just the two period of data, then how we will find out the volatility? Means the volatility on 1st of January, I am standing on the 1st of January, lambda is the weight, lambda is the weight. Clear? So I am giving weight to previous day volatility. I am giving weight to previous day volatility. What is the remaining weight? 1 minus lambda. Suppose my lambda is 0.1, that is 10%. So what is the remaining left weight? 0.9, that is 90%. That will be multiplied to r square n minus 1. See, here I am standing on 1st of January 2022. Clear? This volatility is of 31st of December 2021. This return is also of 31st December 2021. Just one day before, we will take the data of one day before, that is the most recent volatility, the most recent return, and taking the cumulative value, and based on them I am forecasting the volatility on 1st of January. Clear? And this equation also known as adaptive volatility estimation. Adaptive, write down, adaptive volatility estimation. Now you are using the word adaptive. Why? Because see, you are using the most recent volatility into your model. Clear? And definitely you are estimating the volatility. Clear? Now this formula is easy as compared to this formula, because if suppose you will be having 1000 days return, so you have to find out the same for 1000 days, but this will simplify with only two terms, that is the recent volatility and the recent return. Clear? Second, suppose if on the say 457th day, 457 day, if there is a huge decrease in the return or huge increase in the return, can impact the volatility badly. Can impact the volatility badly means the past event can also impact my volatility today. This is something which I don't want. So I have removed all the possible, I have removed all the possible past event, just including the most recent, that is the yesterday. The most recent, that is the yesterday. Clear? So two benefit: one, you don't have to find out, you don't have to spend huge amount of time on calculating 1000 days data. Second, you are focusing only on the yesterday's data, means you are not giving any weight to data which have taken place 500 days ago or 1000 days ago, because if there is a huge spike, whether it is positive or negative, it can impact the volatility, it can impact the calculation of the volatility. So we have completed our EWMA model. Okay, so whenever you will be getting the question, you have to use this formula. You will be given with the value of lambda, value of recent standard deviation, recent volatility, as well as the recent return. Clear? Okay, let us move ahead with our next portion, that is Garch. Okay, now, when I am saying that I am using the gauge, it is somewhat similar to EWMA model. It is just incorporating one additional thing, that is the mean reversion. That is mean reversion, which is missing in EWMA, because it have been seen that volatility follows mean reversion. Volatilities follows mean reversion means it will come back to its mean level. It will come back to its mean level. If it is at the higher level, it will decrease to mu, and if it is at lower level, it will increase to mu. Clear? It will increase to mu. So the feature of mean reverting is known as long run level of variance. Long run level of variance. Okay, so mu is actually the long run level of variance. So with the help of the gauge, how will I be able to find out the volatility? It is equals to omega plus your alpha r square n minus 1 plus beta sigma square n minus 1. Clear? Now you can think of alpha as 1 minus lambda, beta as lambda. Clear? So this portion is similar to EWMA. What is adding additionally is our omega. What we are adding additionally is our omega. Clear? Hopefully you are understanding. What is your omega? What is your omega? This is actually your gamma. This is actually your gamma multiplied with VL. Multiplied with VL. What is VL? This is long run average variance. Long run average variance multiplied with the gamma is actually your omega. Is actually your omega. Clear? So in case if write down, if omega is equals to 0, then Gauge will be equals to EWMA. If omega will equals to if omega equals to 0, Gauge will become EWMA. Now how to find out VL? If the question will ask you what is the long run average variance, how you will find out? This will be equals to omega divided by 1 minus alpha minus beta. 1 minus alpha minus beta. Now what is this alpha minus beta? Try to understand. If I'll write the equation like this, sigma square is equals to gamma VL plus alpha r square plus beta sigma square, beta sigma square. Clear? Now if my alpha is 30%, if my beta is say 80%. Clear? So what is the weight of the gamma? The weight of the gamma is, okay, I need to change it. this needs to be 60%. Clear? So the weight of the gamma is 10%. Clear? So if I know alpha, if I know beta, how I will be able to find out the gamma? This is actually 1 minus alpha, 1 minus beta. So 0.3 minus 0.6 will give me 0.1. So gamma is nothing but the weight. Gamma is nothing but the weight. Clear? So try to think like this. This is like this. Clear? This one is like this. Clear? So you want to find out VL, you want to find out VL. So VL is equals to omega by gamma, omega by gamma. So what is gamma? 1 minus alpha minus beta. Clear? We'll do one question on gauge and you will understand everything completely. Suppose your omega is 0.5 times 0 and then 3. Your alpha is 0.04, your beta is 0.92. Clear? Then your volatility given to you as 1%, and your recent return given to you as 2%. You need to find out volatility with the help of gauge. Clear? So volatility is equals to omega plus alpha r square. Alpha r square means 0.04. What is r square? 0.02 square plus beta 0.92 multiply with sigma square. Clear? This is sigma, so sigma square will be 0.1 square. Clear? Or if you want the direct volatility, take the square root, remove square from here, you are going to get the value as 0.054%. 0.054%. This is your volatility. Now if the question will ask you VL, that is your long run volatility, so how you will find out? Omega 1 minus alpha minus beta. What is omega? 0.5053. 1 minus, what is my alpha? 0.04. Clear? So when you will solve this, you will get the value as 0.000075. Now this is also square, this is also sigma square. So what will be your sigma? This is the square root, this is your sigma square. Okay, so what will be your sigma? It is going to be 0.866%. Clear? So this is your long run value, and this is your sigma n. This is your sigma n, the recent volatility, and this one is your long run volatility. This one is your recent volatility. Clear? Now when we are doing the gauge model, there is one concept of autocorrelation that will be covering in the time series chapter in the quants, not here. Okay, so now we'll be just at the end of the topic. So we are doing updated correlation estimation. Write down updating correlation estimation. Now you will think of why we are getting this concept of correlation in between this sigma square. See, volatility is somewhere related to correlation. And how you find out the correlation? It is actually covariance by sigma square x and sigma square y. Clear? So correlation is always related to the volatility, the standard deviation which we are calculating. So this is the formula of getting the recent covariance. Clear? You can see that covariance n means today's covariance I want to find out. So I will take the previous one day before covariance. Suppose this is for the 10th of April. So I will take the covariance of 9th of April. That will be multiplied with the weight. 1 minus weight, and I'll be taking the most recent values of x and y. I'll be taking the most recent values of x and y. Clear? Or it can be the returns of x and y. If I have two stocks, it can be the returns of x and y, means the most recent returns of x and y. With the help of covariance, I can find out the correlation. Clear? So which model we are using? We are using EWMA model to update our correlation estimation. Okay, by mistake here I have taken square. This will be only sigma square, sigma x. Okay, by mistake I have written it again. Sigma x and sigma y. This is how we calculate the covariance. Now suppose in the question, if they will not provide you covariance of n minus 1. Suppose if they will not provide you covariance of n minus 1, how you will find out? You will find out with the help of the formula, that is correlation multiplied with the sigma of x and sigma of y. Clear? So correlation will be given to you, standard deviation of both x and y. Standard deviation of both x and y will be given to you. You can use that to find out the previous covariance. And always remember, you have to take the previous standard deviation. So what kind of relationship you will find between correlation and covariance and standard deviation, or we can say volatility? If volatility is increasing, definitely your correlation is also increasing. If volatility is decreasing, your correlation is also decreasing. Clear? So we have completed almost all the topics of this chapter, and I tried to keep the concept very easy because it includes EWMA, GARCH, which most of the students will actually leave and they don't at all prepare. So I have tried to keep it as simple as possible without going into the technical terms. With the example, I have given you the whole concept of this chapter. So just revise it and complete it. It's just a big chapter, and definitely you are going to cover it within 100 minutes, and that will be a really good achievement for all of us. Thank you.